while the world was hungover from New Year's Eve, while the Western financial media was obsessing over the price crash, while retail investors were panic selling their positions because a chart on a screen told them to. The People's Republic of China quietly executed the most significant strategic maneuver in the history of the silver market. It didn't happen with a press conference. There was no breaking news banner on Bloomberg. There was no tweet from a government official. It happened in the fine print of a bureaucratic document issued by the Ministry of Commerce in Beijing. And it happened on a specific date, January 1st, 2026. On that day, the rules of the game changed forever. A new export control system went live. A massive financial bubble within China began to burst, and a strategic supply gap of 2,000 tons opened up beneath the feet of the global economy. Most people are looking at the price of silver and seeing a disaster. I look at the data coming out of Shanghai, and I see a setup. I see a trap. And I see a future where the West wakes up to realize that the flexible supply they built their solar industries on simply isn't there anymore. This is veiled wealth. And today, we are going to expose the China bomb, the three-part mechanism that is suppressing the paper price while simultaneously locking down the physical supply. If you hold silver, you need to understand this, because the market you think you are trading no longer exists. This is veiled wealth, and I need to tell you about something that is going to reshape the global silver market for the next decade. What I am about to share with you connects three seemingly separate events into one coherent picture. We have China's only silver fund crashing 40% in a single week, while still trading at a 30% premium. We have new Chinese export restrictions that just cut global silver supply by potentially 2,000 tons per year. And we have the People's Bank of China flooding the system with so much liquidity that Chinese speculators are piling into metals markets at record pace while their real economy crumbles. These three things are not coincidental. They are coordinated. And when you understand how they connect, you will understand why the recent price crash isn't the disaster it appears to be. It is a setup. Before we dive into the data, make sure you hit that subscribe button. If Veiled Wealth is providing value you are not seeing anywhere else, protect that access. Now let me walk you through what actually happened because the sequence matters. Let's begin with the smoking gun, the event that triggered this entire investigation. To understand the future, we have to look at what changed on January 1st, 2026. For decades, the Chinese silver market operated on a relatively open model. China is the world's third largest silver producer and a massive refiner of imported ore. Under the old system, the system that existed until December 31st, 2025, the export market was fragmented. Small refineries, medium-sized trading houses, and flexible private suppliers could all participate. If the price was right in London or New York, a Chinese refiner could ship silver bars to fill the gap. This created liquidity. It created a buffer. It meant that if the West needed silver, China would sell it. That system is dead. On January 1st, the Ministry of Commerce implemented a new, rigorous export licensing system. But they didn't just ask for paperwork. They added a death clause. To be eligible to even apply for an export quota, a company must now demonstrate a refined silver production capacity of more than 80 tons per year. 80 tons. That number was not chosen at random. It was chosen to function as a scythe. It was designed to cut down the field. In one stroke, hundreds of small and medium-sized refiners, the flexible part of the supply chain, were disqualified. They were banned from the global market. They can sell domestically, but they cannot let a single ounce leave Chinese borders. So who is left? The Ministry of Commerce released the list of approved entities for 2026. There are exactly 44 companies. 44. In a nation of 1.4 billion people and a massive industrial base. And when you dig into the corporate structures of these 44 survivors, you find one common DNA string: the state. These are state-owned enterprises, SOEs, or large conglomerates with deep ties to the Communist Party. Jiangxi Copper, Tolling Non-Ferrous, the giants. These companies do not operate on pure profit motives like a private trader. They operate on strategic mandates. If Beijing says, keep the silver for our solar panels, they keep the silver. If Beijing says, restrict exports to squeeze the Americans, they restrict exports. The West has lost access to the free market of Chinese silver and is now reliant on 44 entities that answer to a geopolitical rival. Let's put some hard numbers on this, because the scale of this withdrawal is terrifying. In 2025, China produced approximately 21,000 tons of refined silver. Of that, roughly 4,000 tons flowed into the global export market. Analysts projecting the impact of the 80-ton rule estimate that exports will collapse by 30 to 50% in 2026. Let's be conservative. Let's say it drops by 40%. That is a reduction of 1,600 tons of silver. To put that in perspective, that is roughly 50 million ounces. That is more than the entire registered inventory of the COMEX right now. Gone. Removed from the board. Where does that silver go? It doesn't disappear. It stays inside China. It flows into the strategic stockpiles of the People's Bank of China. It flows into the warehouses of Jinko Solar and CATL. China is effectively building a silver wall. They are ensuring that their domestic industry has first claim on every ounce refined within their borders, and the rest of the world can fight over the scraps. This is the first component of the China bomb, the supply lockout. While you are watching the chart go down, the physical exit doors are being welded shut. Now, if the supply is getting tighter, why is the price crashing? Why isn't silver soaring to $100 right now? To understand that, we have to look at the second explosion that happened in January, the meltdown of the UBS SDIC Silver Futures Fund. This fund is unique. It is the only exchange-traded product in China that allows retail investors to speculate purely on silver prices. And in late 2025, it became the epicenter of a financial mania that borders on insanity. As the global silver price started to rally, Chinese retail investors who have been burned by their real estate market and their stock market piled into this fund. Assets under management, AUM, tripled in a single quarter. Money was flooding in faster than the fund managers could buy futures contracts. This created a distortion that should be impossible in a functioning market. The price of the fund detached from the price of silver. At the peak of the mania, the fund was trading at a premium of 109.9% over its net asset value in AV. Let me repeat that so it sinks in. Chinese investors were paying $2 to own $1 worth of silver. They were buying silver at a theoretical price of $60 or $70 when the market price was $35. Why? Because of capital controls. Chinese investors cannot easily move their money out of China to buy COMEX futures or physical bullion in London. They are trapped. So, they chased the only vehicle they had access to, driving it to the moon. Then, gravity took over. When the global silver price began to correct, the bubble burst. But it didn't burst cleanly. It burst with the violence of a broken machine. Chinese markets have daily price limits. A fund cannot drop more than 10% in a single day. When the panic selling started, the UBS SDIC Fund hit limit down. Trading halted. The next day, limit down. Halted. The next day, limit down. Halted. For 6 consecutive sessions, investors were trapped in a burning building with the doors locked. The fund is now down more than 40% from its peak. But here is the most disturbing statistic, the one that explains why the chaos isn't over. Even after crashing 40%, the fund is still trading at a 29% premium to its actual value. The bubble hasn't fully deflated. It is still dangerously overvalued. This matters because this fund was a primary driver of the paper sentiment in Asia. When this fund was skyrocketing, it pulled the global price up. Now that it is imploding, it is dragging the global sentiment down. But ask yourself, does a broken ETF in Shenzhen change the fact that solar panels need silver? No. Does it change the fact that China just banned 2,000 tons of exports? No. It is a financial accident. It is noise. But it is noise that is deafening the market right now. So we have a supply lockout, bullish, and a fund collapse, bearish. What is the third piece of the puzzle? The People's Bank of China, PBOC. Why did Chinese investors go crazy for silver in the first place? Because the PBOC is flooding the system with liquidity. Last year, China's two-money supply grew by 8.5%. Meanwhile, their nominal GDP grew by only 3.9%. Do the math. There is a massive gap between the money being printed and the actual goods being produced. That extra money has to go somewhere. It can't go into housing. The property sector is dead. It can't go into tech stocks. Too much regulation. So it goes into commodities. Duncan Wrigley, a chief economist at Pantheon Macroeconomics, put it perfectly. Chinese speculators have ample cash, but nowhere productive to invest it. So they're piling into commodities and driving prices to extremes. This creates a whipsaw market. Excess liquidity drives prices up too fast, the mania. Regulatory panic and profit-taking drive prices down too fast, the crash. It creates extreme volatility that shakes out the weak hands. And while the speculators are getting slaughtered in the casino, the state is quietly collecting the chips. Now let's zoom out. Let's act like intelligence analysts and connect these 3 dots. 1. Supply restriction. Beijing locks down 2,000 tons of silver exports. 2. Market crash. A speculative bubble bursts, driving the price down. 3. Liquidity flood. The PBOC keeps printing money to buy real assets. Do you see the picture yet? China has engineered a scenario where they restrict supply to the West, hurting us, while simultaneously benefiting from a lower price to accumulate reserves for themselves, helping them. It is the perfect crime. From Beijing's perspective, the crash in the UBS SDIC Fund is actually a good thing. It flushed out the gamblers. It lowered the global spot price. And now, the 44 state-approved companies can buy silver on the international market or buy domestic production at a discount. They are buying the dip that they helped create. This is exactly what they did with rare earths. 10 years ago, China flooded the market with cheap rare earths. They drove Western mines out of business because nobody could compete with Chinese prices. Then, once they had 90% market share, they tightened the supply. They imposed quotas. They weaponized it. Silver is now entering the weaponization phase. The West is asleep at the wheel. We are looking at charts. We are drawing trend lines. We are arguing about the Federal Reserve. Meanwhile, China is playing a game of resource dominance. They know that the green energy transition is impossible without silver. They know that 5G is impossible without silver. They know that advanced missiles are impossible without silver. And they have decided that they are not going to be the gas station for the Western war machine anymore. The reason you aren't feeling this, yet the reason the price is $30 and not $50, is because of the lag effect. Supply chains move slowly. The silver that was exported in December 2025 is still sitting in warehouses in London and New York. The inventory drawdowns haven't hit the headlines yet. But fast forward 6 months. Fast forward to June or July 2026. That is when the Western industrial buyers will go to renew their contracts with Chinese refiners. And they will hear the new reality. Sorry, we don't have an export permit for you. Try somewhere else. Somewhere else doesn't exist. Mexico is tapping out. Peru is struggling with political instability. When that demand hits a wall of zero supply, the price discovery will shift from the paper market, COMEX, to the physical market. And the physical market doesn't care about the UBS Fund premium. It cares about ounces in the hand. So what do? If you're listening to this, you are likely part of the 1% of investors who actually care about what is happening beneath the surface. Here is the veiled wealth assessment of the situation. 1. Ignore the screen price for now. The screen price is currently reacting to the liquidation of the Chinese speculative bubble. It is reacting to the UBS fund crashing. This is a paper event. It is temporary. Do not let a paper crash shake you out of a physical asset that is being strategically cornered by a superpower. 2. Watch the inventories. The signal to watch is not the price. It is the inventory levels at the LBMA, London, and the COMEX, New York. As Chinese exports dry up, Western vaults must begin to drain faster. If we see accelerated drawdowns in Q1 and Q2 of 2026, that is the confirmation of the China bomb. 3. Watch the premiums. Keep an eye on the price of physical silver in Shanghai versus London. If the Shanghai premium starts to rise again, not because of a fund bubble, but because of industrial bidding, that means the internal Chinese market is tightening. We are already seeing 1 kilogram bars in Asia trading at significant premiums over spot. That is the smart money bidding for metal, not paper. 4. Understand the geopolitics. Stop thinking of silver as just a trade. Think of it as a strategic metal. If China invades Taiwan, if trade wars escalate, silver is one of the few assets that China holds the keys to. Owning silver is a hedge against the weaponization of supply chains. The events of January 1st, 2026, will be looked back upon by historians as the turning point. The day that global silver market ended and the bifurcated silver market began. A market for the West and a market for the East. And right now, the East is holding all the cards. The crash you are seeing is the smoke. The export ban is the fire. Don't stare at the smoke and miss the house burning down. The flexible supply is gone. The 2,000-ton gap is real. And the 44 companies that control the flow are not your friends. If you found value in this deep dive, share it with one person who needs to wake up. The algorithm hates this content because it is complex. It doesn't fit in a 60-second short. So it is up to you to spread the signal. This is veiled wealth. We don't just watch the markets, we uncover them. Stay liquid, stay skeptical, and guard your stack. I'll see you in the next one.